Hi everybody, this is Thomas Wynn, and I'm here with the 2017 second quarter market review. There's all my contact info on the screen. You have any questions or suggestions, just reach out. So let's jump in. On the screen are the index returns for the second quarter, and as you can see, they're all across the board. Every type of investment pretty much was up during the quarter. And for the year, we're doing real well. I've called out two things. One is emerging markets and developed foreign markets have both leading the market this year so far, after many years of trailing the US market. Foreign stocks are doing better. And then I always want to call out the average returns, the best quarter and the worst quarters. Those really give a lot of context on what expectations are for any one quarter, and whether year to date or for the quarter we're doing better or worse than average. So the next is the entire world. This is the chart of the market, and it shows both the US and foreign stocks and the news that was associated during the quarter along with the price of the market at that particular time. And this is a little zoomed out a little bit. The last slide was just the quarter, and this is for the last 12 months. And then this insert is a big look at all the way from 2000, the last 17 years of chart of the market returns. And there's interesting features on here in the previous slide and this one, and you can always freeze the video and take a look and zoom in if you're interested. But that's the news, and that's the price. And this is zooming in and isolating all the different types of investment in the world and showing in the second quarter what did best and what did worse. And then, so the thing I called out down here is value stocks. The small cap value did the worst in the quarter and is doing not so well for the entire year. And all the other asset classes are doing better. We overweight small cap value because they perform better over time, but we're going through a rough period at the moment. And when you look at just the US instead of the entire world, I've highlighted small cap value again in the period for the year, still doing not very well. And that leads us to this slide, which is sometimes when a particular strategy is not doing well, like small cap value, we're not doing that badly. Last year we did really well relative to all of our benchmarks. This year we're trailing by a little bit. But we just want to go over the general premise and why we do what we do and stick with it. And this is over a long period of time, from 1928 to 2015. This shows the performance of company size, and small does better than large, and this is the difference, outperforms over that period on an annual basis by 2%, a little more than 2%. And that's for US stocks. The same phenomenon is true out in the developed, foreign, and in the emerging markets. So small does better than large over long periods of time. That is what's called a dimension of return, and it's why we overweight these asset classes. In any one year, these dimensions of return are erratic, and I'm going to show on the next slide that no one's found a way to pick and choose which year to be in and out of these things. Every system that's ever been tried has not had good results. So you overweight and then you stick with it. And in addition to company size and small cap value doing better, the relative price, value stocks do better than growth. Here's value in the US versus growth, and there's the difference. Same thing in the other categories. And then we also overweight highly profitable stocks. That sounds like common sense. Why doesn't everybody do it? I can't answer that question, but we do. And so profitable stocks outperform better than less than profitable stocks. And those are the dimensions of return that we use when we're putting together our portfolios. Most of our clients and even our new clients are aware of the other ways that we try to add value by managing risk and increasing income, etc. But let's take a look at this next slide, which tries to talk about small cap value. These bars above the line are outperformance years, and these are below the line. The red lines are underperformance. and over time the average is 4% better. But you can see recently it's been about 50-50 from about 2007 or 8 that small cap has not done great. Now, it's not the only feature that we use for our portfolios, but you want to stay in a philosophy or a strategy long enough to capture the returns that it offers. And you can see there's big clumps of times where just small cap value just kicks butt and gives you outperformance. So we've had a couple of difficult years, but we've overcome that to a great extent, even though last year was a bad year, or sorry, 2015 was a relatively bad year. We've had decent performance and benchmark tracking performance all those years. So going on to a slide that shows performance by country. This is always interesting in the volatility of all the different countries. And the US, as we could tell from the asset class performance, is down at the bottom. And these are the developed countries and the emerging market countries on the right-hand side. And here we have commodities, and I'm calling out gold because we have a position in gold that fluctuates somewhere between about a 1% exposure to gold miners and a 2%. And we've been doing this for about 2 years with returns that far exceed our portfolio, our general portfolio. It's a speculative investment. That's why it's relatively small, and we've had good luck with that over the last couple of years. This is interesting that the year-to-date returns, 1 year, 3, 5, and 10-year returns are all negative for commodities. And for gold, certainly it's going to be negative over those periods as gold fell from its highs. We like to get into assets when they've underperformed for a long period of time. We like to try to buy things low. And then after periods where these numbers start getting bigger and bigger and bigger, we tend to stay away from those assets. We don't know where the top is, but usually there's a period of overvaluation and outperformance where we stay away. And then this is just the final editorial from DFA, and it's basically doing a study of how does the market perform when interest rates go up. And there's basically no correlation. You can't tell. The amount of time the market goes up or down relative to interest rate changes is just neutral. And I'd even go so far as to say, this is the end of the last slide, that there's not even a very good correlation between rising and falling interest rates and the price of bonds. And we've kind of seen that lately as bonds have been going in the opposite direction as interest rates, and have been pretty volatile over the last 2 years. So that's all I've got to say about that. If you want to stop and take a look at any slide, you're welcome to. And if you have any questions, please get in touch with me anytime. Thanks a lot. Bye-bye.